Hello, this is Steve Schwartz coming to you from Market Traders University and the virtual studios of Market Traders TV. This is Wednesday, July 22nd. Today we're going to be looking at the crude oil market. If you have read my previous blogs on markettradersuniversity.com, you'll know that I've been calling for a Fibonacci correction of 38% roughly from these highs to these lows, and then the bounce to the 38.2% correction of the total loss of the highs to the lows. That would be approximately just over $15. The actual correction brings it to about 66 and change. It did spike above that, but now is settling back down below it, and it is just showing more confirmation that this was nothing more than a correction in what I would call a bear market. And the market bounced in the past week and a half, simply because it was wishing and hoping for recovery. The crude oil prices had been gaining on the hopes of economic recovery as well as reports of declining inventories. The uncertainty for the next coming months, because of all of the information coming at the market showing now weakness or cross currents of not knowing really where we're going from a recovery standpoint, traders were forced to take some profits in front of several reports. The first report yesterday was the American Petroleum Institute report, which announced a 3 million barrel increase to 349.9 million barrels for the week ending July 17th. Well, back that up, or follow that up, I should say. Today we have the Energy Department's release. That's from the Energy Industry Association. That's an energy-run department, and that report comes out this morning. I'm doing this recording before the report so I can do a follow-up recording later in the day. Hope that you keep track of it. Well, oil supplies are definitely on the increase. Market volatility has been decreasing, and we're trying to make sense of what type of strategy to use. Well, if you don't want to go outright short, you want some protection because you might think that some shoe may fall on the other foot and send prices higher because of geopolitical tensions. I think that may be a wise idea. What I would think to do, if I were you, is to take a look at this closer chart. Let's take a look at the pattern. The pattern on a 60-minute chart over the last 3-4 trading sessions obviously show at this point a sideways trading range. It's pausing. It has been pausing for the report. As you can see, the market, as I spoke earlier, the market did spike above 66.50. The Fibonacci correction was right in here. And I should say in here, it spiked above it, but now has fallen back below it, leading me to believe that that 38% correction is holding as a ceiling. But nonetheless, if one thought that the market was going higher, there wouldn't be a bad idea using what I would call as a volatility play. And how do you do a volatility play? It's an option play where you're buying outright long calls, 67 calls, just above resistance was hit, and 64 puts, buying the 64 puts. They're called strangles, volatility spreads. There's a variety of different terminology to use it, but I will call it a volatility spread, where literally you're bracketing the market with long calls and long puts. It takes the guesswork out of the market, especially when a market falls into a sideways trading range like this. Once again, the Department of Energy is releasing its report at 10:30 a.m. Keep an eye on it. And basically, what you want to do is look for, if you get an increase in supplies that are above expectations, you certainly want to take on a position of going short the market. It has bounced against resistance. Just make sure if there is a short position put on, you put a stop above the 66.50 area in futures. If you do a volatility strangle and the market does break above this resistance, it will mean that there'll be another leg higher, and you should offset the long call position, letting it go, and offset the long put position, and let the call side of the volatility spread run. So once again, I want to thank you very much. It is July 22nd on Wednesday, and right in front of the Energy Industry Association's report. May the great trades be yours, and good luck today.